Folks, the global economy is collapsing in front of your eyes. If you live somewhere, anywhere on this specific blue rock, you need to be watching this video and understanding what is going on. We're going to go through this step by step, and then you can tell me the picture that you see painted here. So CNBC has on their website these index ticker tapes, and when I was shooting this video, you had the Dow making a new low for the year, the S&P 500 and NASDAQ not far behind, but it's also the same thing in Europe with the German DAX, the London FTSE, the French CAC, and the Euro Stock 600. You go to Asia, the Tokyo Nikkei, same thing, the Shanghai Index, Hong Kong, Korea, Australia. In Australia, the kangaroos have lost nearly all of their pension funds, and because of inflation, they have to hop twice as high. But the fact of the matter is that no matter where you are in the world, nearly every major equity index is down and reaching new lows for the year, or is about to. And the reason for this, well, the reason is that investors know that at best, we are heading for extreme economic slowdowns, and at worst, full-blown economic apocalypse. Folks, we have already seen the collapse of currency after currency after currency, yet we are expected to believe that everything is just peachy, berries and roses. Don't worry, don't look over there, nothing's happening. Everything is just great. The leaders in the world, they're handling everything perfectly. No, folks, that is just not the truth, and if you believe that, you are going to be handed your rear end on a platter, and you're going to be like, hey, actually, I'm vegan. This is from the World Bank just a few days ago. Central banks around the world have been raising interest rates this year with a degree of synchronicity not seen over the past 5 decades, a trend that is likely to continue well into next year, according to the report. World Bank President David Malpass just said, quote, global growth is slowing sharply, with further slowing likely as more countries fall into recession. My deep concern is that these trends will persist with long-lasting consequences that are devastating for people in emerging market and developing economies. So let's talk about how global economies are handling this. Let's actually start with a country that isn't raising rates, Turkey, and the ramifications they are seeing for refusing to do so when inflation is spiraling. CNBC reported yesterday morning that Turkey is cutting interest rates again as the country struggles with under 80% inflation, just under 80%. The country's monetary policymakers opted for a 100 basis point cut. This was after a 100 basis point cut in August as well. This is a country of 84 million people who are struggling with just under 80% year-over-year inflation, and the central banks over there just can't seem to cut rates fast enough. Why? Well, because countries in today's global economy have two options. Number one, raise rates with the rest of the world and destroy their own economy in hopes of partially savoring a little bit of their currency's value, or number two, continue with easy money policies that help prop up the economy but completely derail and collapse your currency. Number one, price stability or economic growth. But if you choose economic growth and you sacrifice price stability, eventually everything just collapses anyways, right? It just delays the inevitable, especially when countries around the world are choosing price stability, because people will just flock to those currencies. This is a map of Turkish inflation versus their central bank's policy rate. You could see very clearly that as inflation ballooned early this year, central bankers started cutting rates, not raising rates to counterbalance these inflationary pressures, but actually cutting them, making them worse. Keep in mind that when you go this route, all of a sudden it actually props up your economy a little bit longer than it would if you decided to cut back and try to help and prop up your currency. Turkey is one of the few countries left today that is still experiencing a relative economic boom. Haaretz reports the plunging lira helped boost Turkish exports 16.4% year on year in the second quarter. Growing exports and soaring consumer spending caused Turkish gross domestic product to expand at an annual 7.6% in the second quarter, the highest among G20 economies. And Turkey again symbolizes very well the choice that countries have to make right now. Do we try to fight for price stability and destroy our economy at the same time? Or do we continue allowing our economy to be propped up by easy money policies and infusion of tons and tons of capital that result in a complete destruction of our currency and will eventually down the road result in massive economic collapse anyways? Let's move over to Japan. The Wall Street Journal reported just yesterday, quote, Japan jumps into market to buy yen for first time in 24 years. The rare intervention was the latest example of global concern triggered by the strong dollar, which has gained ground on the back of the Federal Federal Reserve's interest rate increases. Quote, one nation hit by the fallout of the strong US dollar is Japan, the world's third largest economy, which has to pay more for essential imports of oil, natural gas, and food. These imports are generally denominated in dollars and now are costing more in yen terms. How many yen $1 buys? So what's happening here? Well, as the U.S. tightens their own monetary policy, the U.S. dollar is getting very, very strong compared to other currencies whose own governments and central banks either haven't tightened enough or whose citizens have more faith in the future of the USD versus their native currency, which is causing what? A run on native currencies that are already being devalued by insane inflation and insane energy costs. And quite frankly, here at home, the USD is no beaut either, but it is a beaut compared to a lot of these other countries because of this phenomenon that happens when you have a world reserve currency that is getting tighter. You look at the US dollar index, the USD went from losing value relative to other currencies into 2020 and 2021 to skyrocketing in value all year as the Fed has tightened. And because the USD is skyrocketing, you have a lot of countries' central banks going and trying to follow very, very close behind what our Fed does and what Jerome Take Our House Powell is deciding. And so the same day as the Fed meeting this week and announcement on the new rate, the countries that raised rates immediately afterwards were, yes, Japan, Switzerland, the UK, Norway, Indonesia, Taiwan, the Philippines, and South Africa. Argentina just raised rates by 550 basis points this morning to 75%. Imagine the interest on a home loan in that country. But in reality, Argentina has an inflation rate that's like 80, 90%. Some are projecting 100% by year end. So if you are borrowing money at an interest rate of 75%, what is your real rate? It's still negative if inflation is well above 75%. And that's a real problem that central banks are facing right now. In terms of other central banks that have raised rates aggressively this year, you have Saudi Arabia, Poland, New Zealand, Czech Republic, Israel, South Korea, Chile, India, Mexico, Canada, Brazil, Indonesia, and of course the European Central Bank, which controls the euro for all the countries that hold that as standard currency. The euro is also one of the bigger world reserve currencies as well, alongside the pound and the US dollar. But speaking of the British pound, the pound sterling, let's go ahead and look over at the UK. BBC reported yesterday that the Bank of England has raised interest rates from 1.75 to 2.25, the highest level for 14 years, and warned that the UK may already be in a recession. In terms of how they define recessions in Europe, I went ahead and looked up the definition. In the EU, a recession is defined as, quote, zero or negative growth of GDP in at least 2 successive quarters. In the United Kingdom, it is defined as, quote, negative economic growth for 2 consecutive quarters. Now, due to the innovative leadership here in the US, we actually redefined the word recession, which is going to protect our economy greatly from this overall economic collapse. But over in Europe, policymakers have neglected. They've neglected to redefine away the recession, which means when further GDP prints come out and they come out negative like our last 2 quarters here have in the United States, well, that's very likely to be declared recessionary. So that means over in the UK, they are raising rates into a recession in order to get inflation under control, but inflation shows no signs of stopping, neither does the economic slowdown. Quote, inflation, the pace at which prices rise, is currently at its highest rate for nearly 40 years, leaving many people facing hardship. Prices are also widely predicted to head higher in October, despite a government plan to limit soaring gas and electricity prices for households and businesses. This is what the British pound's value looks like right now compared to the USD, straight down. So whether you are looking at some of the strongest economies and most developed economies on the face of the earth, or you are looking at some of the emerging or developing economies, quite frankly, they're all struggling quite a lot. And as the most powerful central banks raise rates, it is forcing a global shift in capital at the same time where we are seeing a global economic collapse in activity and production everywhere. Countries were already dealing with insane inflation because of all the money we had to print around the globe to get out of the pandemic, and because of the massive energy crisis and the overall shortage of everyday goods and services. But the global tightening of the financial system is destroying the economy at a much faster clip, and will continue to do so as countries face the 2 choices of, do we destroy our currency or do we destroy our economy? The Wall Street Journal reports around the world, trade volumes are sputtering and inflation is crushing household and business confidence. China's housing market is cracking while Europe's energy crisis is hammering factory output. The UK's unveiling of the country's biggest tax cuts since the early 1970s, a measure designed to kickstart growth, caused a slide in the pound and a big jump in government bond yields, underscoring the narrow options governments face as they try to combat a toxic mix of low growth and high inflation, aka stagflation. We are entering global stagflation, global economic apocalypse, and I don't think it's going to be very pretty, folks, and we are just in the beginning of this story. Anyways, folks, that caps off this video. Make sure to get your up to 15 free stocks with Moomoo. A great way to fight off this recession in your own portfolio is to get some free stocks, and I will put the link to Moomoo down below. If you're interested in stepping your stock market game up during this market condition and learning, getting a foundation on how to take advantage of some opportunities as they appear, such as, for example, the short indexes, which are going up very, very fast right now, make sure to check out ZipTrader U down below. Members will get unlimited access to our step-by-step lessons, private chat, daily morning briefings, and of course, full price target list. Anyways, have a great rest of your day, and I will see you in the next video.